Hi, everyone. It's Jason here with the NCM Global Income Growth. It is Monday, October 24th. Just giving you a quick update on what's going on in the fund. Right now, we are at about 9% cash. We are at 13.5% fixed income and 78% stocks. A little bit on the conservative side, just kind of waiting to see how some of the market issues are going to pan out. There's reasons to be optimistic, but I think there's two things that the market's waiting for right now. We've got the U.S. midterm elections coming up, and everybody's kind of sitting on their hands. And then, of course, the elephant in the room, or the 900-pound gorilla, whatever you want to say it, is going to be, what is the pivot? When is the terminal rate? What is the issue at which the Fed and the central bankers around the world want to stop raising rates? That's anybody's guess. And as that gets pushed out, or as that gets rolled around, you're going to see this massive volatility in the markets, and we've seen it. VIX is huge. Markets are up, markets are down. They don't seem to be going anywhere and grinding anywhere. Some of the other more salient things that are happening, one of the things I look at when it comes to asset mix switches is it's pretty simple. What's the 50-day moving average doing against the 200-day moving average? Right now, we're clearly a downtrend, so that means you want to be underweight equities. The sharp end of the spear with regards to risk is what the consumer's doing, and I'm looking at the consumer discretionary space in the US and in Europe. With relations to the rest of the markets. And it's not really winning, it's not losing, it's just kind of muddled through. So there's no clear signal there. People, like I said before, sitting on their hands. And then the other thing, NASDAQ futures, where are we at with that? There's a clear buy signal in the market from that perspective, meaning all the small traders, speculators, hedge funds out there are very, very aggressively short. And you kind of want to be on the other side of the boat with that. So it's kind of a mixed bag, hence the reason the 78% equities in the portfolio. Just a couple of things from an international perspective. China has just proven again it's uninvestable. You saw what happened with Xi Jinping and the consolidation of power. Just to kind of highlight what that does to capital, Carnival Cruise Lines probably about 10 years ago started to build a couple of ships in China dedicated to the China market. They're pulling out because this is a global portfolio. Another thing that I like to highlight is the fact that it's go anywhere. Canadian banks, it's tough to argue against Canadian banks. They haven't been performing that well, but every time we turn around, there's been a U.S. bank or there's a European bank that just steps in it. Credit Suisse just agreed to pay 240 million pounds to settle. Or I guess that's euros, to settle a French lawsuit without admitting culpability in citing undeclared funds and stuff like that. It's just with the point of this portfolio, there's no point stepping in it. So we're just kind of being very, very risk adverse and proceeding with caution, but still thinking that the long-term trend is up for the equities. So with that, hope all is well, and we'll talk soon. Bye.